All right, everyone. This is the second video in our series of videos for our Chapter 5 homework. And in this video, we're going to look at our discussion question, quick study, exercise problem, etc., etc. And like always, first thing I like to do is to take off our grid lines there. And just because I like to give myself a little more space here, add a couple rows. Okay, so let's look at our discussion questions here and have a discussion. So this first number one says, what two arguments tend to justify classifying all costs as either fixed or variable, even though individual costs might not behave exactly as classified? So the two primary arguments as making this kind of, I don't want to call it arbitrary, but this distinction anyway. I'll put it in a text box here. Let's see. So two arguments for classifying costs as either fixed or variable include, there's usually some variation, even if the costs aren't 100% fixed or variable. So we'll say variations in the cost, or let's call them minor variations in the costs tend to offset each other. So at least that's kind of one of the assumptions, that we can make in this type of argument of using this sort of analysis methodology, is that even if we make these determinations of these costs in very hard line analysis figures, again, this is an art, not a science, remember that. And so the reason that we can kind of argue that this methodology at least makes sense from an analysis perspective is that the variations can offset each other. And then number two is that the costs will behave, or let's just say will remain as fixed or variable within what's called a relevant range. So, for example, if we're going to be the range at which those fixed costs remain fixed, right? So if your business is, a good example from the video lecture was like a taco truck or a food truck. Your fixed costs might have to do with just the truck, and costs associated with that, maybe some rent, for the space to have your truck, so on and so forth. And there's a range of income that you could earn. It can't be unlimited without incurring some additional fixed costs. So maybe having to buy a second truck, having to pay rent at a second location, or just more rent within a given location, so on and so forth. So when we're talking about these fixed costs, we're basically talking, about the range within which those fixed costs remain relevant and don't need to be increased, essentially. All right. And so those are kind of two of our assumptions that we need to make, or arguments that can be had in terms of why that kind of analysis makes sense. Okay, let's look at number two. So the ability to perform cost-profit analysis is a very important skill. What real-life questions can be answered with this type of analysis? So some of the questions that can be answered with this type of analysis include but at what point will my business break even? Obviously, I think that's one of the most important parts of our analysis that we do in this chapter. What level of sales in dollars and units would be needed to earn a target net income. think of what else. Another thing to think about is what sales price is needed to make a certain profit. We don't really play around with that too much in these problems. More so we have kind of a set sales price that's given to us in a lot of the problems that we do in this chapter. But remember that is also a factor that's within our control. And so if we are looking, excuse me, yawning a lot this video, sorry. If we're looking to change one of the variables, if we look at some of these problems we did in the previous video, we are looking at sales per unit, of, for example, $150, and that all comes into play to give us a certain contribution margin. But if we're able to increase the sales price, that will increase our contribution margin, per unit, basically. But we do need to then take into account, supply or demand, at different price levels and things like that. But if we know, this analysis would tell us, if we were to raise and we're able to raise, sales price, what that would do to, our break even or our profit, etc. So yeah, lots of really good questions that can be answered from this type of analysis. Okay, I'm just copying this down here. Give ourselves a little more space. Okay, describe the concept of relevant range. How does this help with the accuracy of CVP analysis? And we kind of talked about that previously with our food truck example, that these fixed costs really only pertain within a given range of production. And if we were to, go above that level of production that can be handled within one location or at least within that range and with those fixed costs, then we need to bump up the that relevant range. Wouldn't make any sense anymore because fixed costs would have to be higher. And so the basic concept here is that when performing the CVP analysis, we must assume that sales and production are within the relevant range, and normal relevant range is within 80 to 100% of normal capacity for production or for operations. And within this relevant range, the fixed, or let's say the behavior of fixed and variable costs remains consistent in our analyses. So again, if we get beyond that, relevant range, we're up beyond 100%, then that's not going to make any sense. We can't remain, in operation at that level beyond capacity. That's where we'd have to say, okay, well, our fixed costs now need to increase, and so we have to make some changes, essentially. All right, let's take a look down and changes within our analysis to account for that different fixed costs, and just different, maybe the variable costs even change too. Maybe at very high levels, the variable costs, maybe they become lower because you're buying in bulk, and at very low levels of production, maybe the variable costs are higher because you're not getting bulk discounts for making purchases from vendors, etc. Okay, in cost volume analysis, what is the estimated profit at the break-even point? The estimated profit at the break-even point is 0. Nothing, right? That's the whole point, is that That's just the level of sales at which we break even. No, we don't earn any profit. We're just covering our fixed and variable costs and making $0 basically. And hopefully we make above that. But sometimes, as we've mentioned before, I mean, at least you don't want, it's the point at which you're not losing any money as well. Sometimes that can be necessary for a given, depending on the economics, the current moment, basically, for a given business. So, okay, let's look at the last problem here. 5, think about this one for a minute. Plan with the numbers before you answer. Each of the two similar companies had $20,000 in sales, total cost of $15,000. Companies A total costs include $10,000 of variable costs, $5,000 of fixed costs, and if company B's total costs include $4,000 of variable costs, $11,000, which company will enjoy more profit if sales double? And let's not do a text box. Let's do a Excel for this one. So just a little impromptu spreadsheet. So let's put sales, variable costs, contribution margin ratio. Let's see here. Let's do, let me add a couple spaces. Let's do company A and company B. Okay. So when we're looking at these two companies, then we want to look and see what is our contribution, just like we've laid it out here. What's our contribution margin? Sorry, I spelled that wrong there. Okay, so let's put in what we know. So we have sales of 20,000 and sales of 15,000. I'm gonna put in some guys there. Okay, so that's our sales. Total costs include 10,000 of variable for company A, and we've got fixed costs. And there, let's see if we'll need that. We've got 4,000 of variable costs there. Let's see what our contribution margin then is our sales minus our variable costs. A little bit higher for company B. And then we can say our contribution margin ratio, again, taking our contribution margin divided by sales. That's a percentage. So let's just judge that out. We'll pull that formula over. Oh wait, did I put that in right? Let me check my numbers and make sure I got these in right. So company A's total. Okay, so each of two similar companies, has sales of 20,000. Yeah, I messed that up. And total costs of 15,000 per month. So the same total costs, but company A includes 10,000 variable. Company B includes 4,000 variable. Okay, there we go. And then we can see, okay, so there's quite a bit more contribution margin related to for company B. So let's say company B will make more profit on each additional dollar of sales. And let's see here. So if we increase our sales. And one thing we can do here. Yep. Sorry, my video cut off there. Restarted it. Okay, so one thing that we can use, one tool that we can use to analyze how much our profit will increase based on a change in sales is something called the DOL, or the degree of operating leverage here. So DOL, and what that is going to take our contribution margin divided by pre-tax income. Let's move our stuff over here a little bit. And what this is going to tell us here is basically to say, again, from our contribution margin perspective, as we have increases in sales, how much is that going to increase our profit, basically? So again, contribution margin divided by pre-tax income. And so it tells us the pre-tax income is $5,000 for both these companies. Right? We had 20,000 sales minus 15,000 total costs. And we'll just drag our formula over because it was the same 5,000 for both. And then it's here we mentioned, increase in sales of 200. Let's say 200%. So doubling, basically, right? And so that's what if we're assuming if that is the increase there, then our change in profit from using our DOL formula, we just take that, it's going to double so we'll go up 400% if we have a 200% increase in sales at the 50% contribution margin ratio. And for company B, it'll go up 640% in profit using our contribution margin ratio and our degree of leverage calculation to say essentially that company B will enjoy a much larger increase in profit based on the increase in sales, essentially. And it really all comes down to that margin ratio again, and how much of the variable costs is eating up your profit. Essentially, you can tell in company A, it's eating up quite a bit more of the profit, basically. So, all right. So yeah, company B is doing better there. Okay, let's move on to our QS tab, or quick study tab here. Let's take our grid lines off. And which one of the following is a correct assumption that underlies CVP analysis? Explain your choice. Okay, so I'm just going to put a text box in again. And see what our options here. So for cost classified as variable, the cost per unit of output must change constantly. No, that's opposite, right? Because we're saying that the costs are variable, so they increase per increased unit of production the same. They don't, the cost per unit don't change, they stay the same if they're variable, right? Fixed costs will go down as the amount of production increases within that relevant range. So number 2 says for costs classified as fixed, the cost per unit must remain constant. No, that's what I just said. It's kind of opposite. Those costs per unit will go down as more units are produced, but the costs stay the same, right? They're the same because they're fixed. Number 3 says all costs behave predictably within the relevant range. So that sounds pretty good. What does number 4 say? The selling price per unit must change in proportion to the number of units sold. So, yeah, that doesn't make any sense. So that it must change in proportion. The selling price per unit stays the same generally. I mean, that's kind of up to our decision point there. And it's not, in the problems that we're working in this chapter, we're assuming that the selling price per unit stays consistent. So number 3 is the only correct assumption. Is the only correct, or let's say is the only correct answer. And the assumption in CVP analyses is that the company operates within the relevant range. Okay, let's look at number 2. The following information is available for a company's maintenance costs over the last 7 months. Use the high-low method to estimate both the fixed cost per month and variable cost per unit for maintenance costs. Okay, so let's go ahead and do our high-low. So step 1 in doing this is to find our variable cost per unit. And so remember, to do that, we're going to take our, maybe I'll just write it out over here. So let's see. You can see it in the formula here. So what we're going to do is we're going to take our high month minus our low month in costs. So let's take a look here. We got 8,100 minus 3,600. So the biggest swing there. And then we're going to take the maintenance hours basically for these two. So we've got 48 minus 12. And so we get $125 per maintenance hour of variable cost. Okay, so again, that was the high month minus the low month. Oh, you know what? I should just, sorry, I'll do that same. Select the numbers there. So high minus low, and high minus low. And it doesn't really matter. I mean, whatever the driver is, that's what we're, high low is start do with the cost in the numerator there to start with. Okay, and then we want to find our find our fixed costs. So if we look at our high month, we got 48 hours. We've got 125 of our variable cost per unit. And so if we multiply those together, we get $6,000 of total variable cost at our high production there. And then let's do a little calculation here. So our 8,100 is our total maintenance cost. And so we have total cost at high level. Again, I like put the dollars on just so we can make sure we're identifying that. Then we've got our total variable cost right here. And then we just want to take the difference between the two to get our fixed costs. And that would be the difference of $2,100. And then we can basically go through and assume, again, this is more of an art than a science, right? But if we could go through and say, okay, if 2,100 is our fixed cost, that each of the portions here, so if this was fixed cost and variable cost, so fixed cost would stay the same throughout, and then the variable cost would be the additional portion above that. And let's do our currency there. And you can see that becomes, a way to analyze it. Again, it's kind of an estimate. It's not a perfect science, but it's a way for us to develop an idea of what that fixed cost versus variable cost kind of breakdown basically could be. So just put that in our same format. And pretty cool. Kind of a cool way to figure out, or at least estimate, some of the fixed costs there, etc. Okay, let's go on to our EX tab. And let's Red lines. Okay, so this problem says here, if a product sells for $250 per unit and its variable costs are $170, the fixed costs are $450,000, and if the company wants to earn $30,000 income before tax, how many units must be sold? So we got pretty good at this when we're doing our work practice feedback exercises. So let's knock this out. Hopefully it's pretty simple. So we know what our contribution, or we can calculate our contribution margin per unit. So we've got 250 sales price minus our variable cost, PC, and that gives us $80 of contribution margin per unit. Okay, and then we've got we could do our break-even calculation in per units by just taking the fixed cost of 450,000 divided by 80. So if we wanted to break even, we would know that we'd need to sell 5,625 units. But we want to figure out how we can make 30,000 before taxes. So we add that on to the amount there, and we can determine that based on those figures, again, fixed costs plus our additional income above the break-even point divided by the contribution margin per unit tells us that we need to sell 6,000 units to earn our 30,000 pre-tax income. Not too hard, hopefully. Okay, let's come down here and look at number 2. So number 2 here on our exercises tells us that Braxton Corporation earned an after-tax net income of $150,000, fixed cost of $625. Selling price per unit was $150, of which $50 was contribution margin, and the income tax rate was 40%. Okay, so we're going to kind of back into how many product units were sold, etc. And let's, so step kind of A, then if we want to figure this out, do the first part. So we want to calculate net income before taxes. So after taxes was 150,000. So we want to calculate after taxes. We take our 150,000 divided by 1 minus the tax rate, which is what was it, 0.4 is what it said. And let's put brackets around that. We don't need this first one. So basically our pre-tax net income would have been 250,000. And if you think about, just how this would work, if we say 40%, 0.4 was our tax rate. And this is what we're doing when we do that kind of calculation, is to say, take 40%, it would have been of 250,000 equals 100,000. And if we take away that 100,000, if we take away the 100,000 from the 250,000, then you end up with 150,000 after tax, which is what it told us. So that's how we that's what our formula is doing when we take the 1 minus as the denominator. Grossing it up is the way to kind of say that to get us to our pre-tax net income. Okay, so let's see here. Take a look at what our you know what, I think there's a little additional stuff that's hard to see here, so let me pull that down for y'all. Okay, there is a C. So when you're going through, well, hopefully you're watching the video, you'll do problem C there, or part C. Okay, so how many units of product were sold last year? So if we are trying to get to the analysis of what total number of units sold, we're going to need to figure out what was our total pre-tax, our pre-tax plus our fixed costs, right? So we got pre-tax. So pre-tax plus fixed, let's bring that down, plus the fixed cost, it says, of 625,000. This is fixed costs. So 875,000 is our total there that we can use within our contribution margin kind of target net income calculation type of deal that we did. So we, again, if we were to do this in our formula that we did before, we would take our fixed costs, kind of like, doing the break even point, plus the 250,000 divided by the $50 contribution margin. It tells us, would tell us that we must have sold 17,500 units in order to make 250K pre-tax net income, or 150K after net, we'll just call it, say, net income, i.e. after tax. Okay. And then C just asks us about the break-even point, which is kind of what we already did here. So I'm going to copy this. We've been doing it sort of the other way around, and the other problems do the break-even first. But then if we take out the target net income, or the additional amount there, and just get the break-even point using our contribution margin and to cover our fixed costs, you can see that units in order to break even. So it's just kind of using that same methodology that we've been practicing to kind of move through this whole thing and figure out, we can use this to kind of look backwards like we're doing here. And then usually what we would use this for is more of a forward-looking, forecasting kind of methodology for the future to figure out how much profit we expect to make, etc. But you can kind of look backwards to sort of develop some of these analyses to then move forward with. Okay, so that was our problem EX. Again, that's just down to C. We had to kind of pull that down to see it. All right, so on to our PR problem tab here. And this one has kind of a lot of detail and information here. So I think a video really makes sense for this one for you all to follow along. Hopefully you're able to kind of follow along with what we're doing. And yeah, a lot of information here. So let's start sifting through. So we're saying this company this year earned a disappointing 4% after-tax return on sales, net income divided by sales, from marketing 50,000 units of its only product. The company buys its product in bulk and repackages it for resale at the price of $20 per unit. And we've got the following costs. So we have total variable unit costs of $40,000, total variable packaging of $50,000, fixed costs, and our income tax rate. Okay, and then down here it says the marketing manager claims that next year's results will be the same as this year's unless some changes are made. And the marketing manager predicts the company can increase the number of units sold by 60%. That's a pretty big increase. If it reduces the selling price by 20% and upgrades the packaging. This change would increase variable packaging costs by 20%. So our variable packaging costs here. Increased sales would allow the company to take advantage of a 25% quantity purchase discount on the cost of the bulk product, since we're selling more. Neither the packaging change nor the volume would affect fixed costs, which provides annual output capacity of 100,000. Okay, so we want to compute the break-even point in dollar sales under the existing business strategy and the new strategy that alters both unit sales and variable costs. And then 2, we want to prepare a forecasted contribution margin, 2 columns showing the expected results of the strategies. And we want to include sales, variable costs, contribution margin, fixed costs, income before taxes, and then net income. And then determine the after-tax return on sales. So a lot to do here in this problem. So let's get started. So it gives us a couple figures here. It's telling us that we have the current strategy is $20 per unit, and it tells us we had 50,000 units. And what did we get? Does it tell us? It just tells us $20 per unit. But then it tells us here, so $16 would be our reduction in the selling price by 20% that it tells us. So we've got those two given to us. So this is the 20% sales price reduction. And let's take a look at our variable unit cost. So that's our amount here. And we sold 50,000. So we've got $400,000 divided by 50,000 products. So that gives us $8 of variable unit cost. And then the variable packaging cost, 50,000 divided by 50,000 gives us $1. And let's see, so sales minus variable cost. So we can do sales minus both of those. So our contribution margin per unit is $11 per unit. And okay, then we're going to look at our amounts here with our new strategy, and it tells we already have our increase or our reduced sales price of 20%. Change would increase variable packaging costs. So that one's going to go up by 20%. So the way we can increase this by 20% is to multiply by 1.2. So that'll maintain the 1 and then add 20% basically to it, the 0.2. And then our variable unit cost, it tells us we can reduce those costs by 25%. So if we take $8 times 0.75, that'll bring our variable unit cost down to $6. And that 0.75 was the taking advantage of the 25% quantity purchase discount. So it's going to be 25% less, or 75% of what it was before. And then we can do the same formula down below. And so we get $8.80 of contribution margin under the new strategy. Okay, so now we need the break-even point. So that was A, and then we need the break-even point in dollar sales. So remember to calculate I'm just going to say BE point, let's say current, and then BE point new strategy. So remember that we're gonna let's do something real quick. So let's do our contribution margin ratio. So we take our contribution margin divided by sales. So under the current strategy, it's 55%, and lo and behold, under the new strategy, it's the same thing. So this doesn't change our fixed costs at all. So our break-even point then here that we can calculate in terms of sales is to take our total fixed cost, right? So what was our fixed cost? 50,500. I can link to it there. Divided by our contribution margin. Now we're essentially going to have the same calculation under or the same number because it's the same contribution margin under each strategy. So let's see. Okay, so we're getting less contribution margin, but we can reduce some of our costs, so we still come out with the same same contribution margin, but now the biggest change that we're saying is that we can increase the number of units sold by 60%. So that's a pretty big difference there. So now let's take a look at that. So again, it tells us to do this calculations, including, where does it tell us? Oh, that was down below. Let me this back up, and we'll do it down here. So we want to show, okay, so it says sales, variable cost, and let's do the, let's just do variable cost and then variable packaging, two different types of variable costs. Contribution margin, fixed cost, it tells us income, let's call it pre-tax income. Let's say tax at 20%, and then net income, and it asks us to calculate a return on sales. Okay, and let's say this is current plan and then new plan, let's call it. Oh, that was funny. Okay, that's fine. Okay, so how many units are we going to sell? So that was, remember, our current plan was just, if we were going to have the similar, it was 50,000 units if we're going to do the same as last year essentially. Or how much did we do there? 50,000 units. Maybe I'll put that in. So units expected sold. But here under our new plan, we said it was going to be 60% higher. So that's going to be 80,000 units because we have a new packaging and we reduced the price a bit. But remember, we still were able to maintain the same contribution margin. So that's good. And we have such a higher amount of sales that we should be expecting to see some pretty big changes here. So 50,000 units, right, times the $20 per unit. I'm just going to do our dollar signs here so that we can differentiate between the units and the dollars. And then this last one, we're going to want to do a percent down here. So just preemptively formatting. Okay, so then our variable cost of packaging will be 50,000 times the variable cost per unit, so 400,000. And the variable packaging cost, $1 per unit times 50,000. Okay, now let's do it for our new plan. So then we've got 80,000 times our 16,000. We've got 80,000 again variable, right? So as our number of units go up, these change proportionally. Okay, and then remember our contribution margin formula is sales minus variable costs. I'll just copy this formula over. Okay, and then we have the same fixed cost under both scenarios. You know what I'm going to do? I'm going to do negatives here too, just to make that clear. And let's summarize those. Add a little space there. Okay, and then our fixed costs, same in both instances. And our pre-tax net income, 49,500 and 200,000. So pretty, you see what I mean? Oh, just copy this formula. Pretty, you can really tell how much of a huge difference that is. And to take our tax now, we're going to take our pre-tax net income times 0.2. And same thing. And then our net, or let's do a negative on that too. Keeping with our style there. All right, so our net income then is very different, right? So we've got 40,000 times 163,000. So obviously this new strategy, the way that it can increase sales by 60% and still maintain that contribution margin ratio basically of the same amount, really shows how much more we can earn with the new strategy. And then figure out our return on sales. I think does it tell us? So basically what we're trying to do is take our net income divided by sales. So how much are we actually earning? So about 4% versus about 12 or 13, about 13, 12.72 versus 3.96. So that really goes to show the amount of increase in profit that you can realize with some possibly minor tweaks to really drive up the sales. And the more volume you can get, if you're able to kind of keep the costs in a relatively stable position, you can really see how much that's going to increase your return on sales overall and your net income, etc. So pretty cool. All right, let's move on to our next tab here. Okay, so in our Beyond the Numbers problem, let's take a look at this. Okay, so both Best Buy and Circuit City sell numerous consumer products. Each of the companies has a different product mix. Okay, assume the following data are available for both companies. Compute each company's break-even point in unit sales, and each company sells many products at many different selling prices, and each has its own variable costs. This problem assumes an average selling price per unit and an average cost per unit. Okay. If the number of units sold were to decline, which company will experience a larger decline in operating profit? And then it says to Google the decline of Circuit City and comment on what might have happened to the company. Okay, so let's get started here. Okay, so let's see what it tells us. We've got average selling price, average cost, fixed cost. So, all right, let's see. Let's just take. Let's see. How do I want to do this? I'm just going to add a couple lines in here. I think the easiest thing to do would be to say average contribution margin. So we'll take our selling price minus our variable cost. So you can see that Best Buy has a much higher contribution margin there. And then if we are going to figure out, let's see, our break-even point. Well, let's just put it in. Let me get some space here. So then we can say break-even point for each one of these. We can take our total fixed costs divided by the average contribution margin. And that would be, how much was this? This is 5.98 million in millions. So so we need to add 6 zeros to this for it to be 1, 2, 3, 4, 5, 6. So if our total fixed cost was 5.98 billion. 1, 2, 3, 4, 5, 6. So then our break-even point in sales number of units, again, taking our fixed costs divided by the average contribution margin per product sold, you can see that we'd have to sell quite a bit more products. What's the difference here? 27 million more products at Circuit City just to break even. So relatively significant. And then problem 2, let's take a look real quick here. If the number of units sold were to decline, which company would experience the larger decline in operating profit? So let's see here. So it's kind of interesting because when you think about this, it's essentially saying that each product we sell, has more profit. And we can say that given that Best Buy, let's do that. Text box. Given that Best Buy has a higher contribution margin per unit, then profits will decline faster given a decline in sales. However, this also means that profit will increase faster given an increase in sales. So, so it's kind of a two-edged sword, I guess, double-edged sword. But it really, declining sales would not be good for either. But given that you can get more out of each sale in Best Buy, with a higher contribution margin, that is generally better overall. So then it says Google the decline to the decline of Circuit City. So I'll let you all kind of actually do this as well, but I'll just talk about some of the things that come up here. This is a good one. Maybe not Google. You can use ChatGPT. I think is an easier one, to actually get some usable data out of. So go ahead and try using some AI to answer the question too. But there was some. Here's some factors that came up when I looked into it. I'll let you all do this yourself a bit though. But competition from e-commerce, as far as Circuit City went. Amazon, for example, was a hit. It's been a hit to like all businesses, but that hit Circuit City. Best Buy had better customer service, more technology in their stores. Again, customer service was kind of hurt by poor leadership decisions, inconsistent pricing. They couldn't really differentiate over Best Buy as far as what is their competitive advantage. The financial crisis came into play. That kind of affected all businesses, Best Buy included, but they were able to weather the storm. Better customer service, more in-store experiences, online sales and offline. Too many stores, so too high of overhead costs, so fixed costs were too high for the amount of sales that they could absorb, right? So expanding too quickly, and that's a pretty common problem in businesses if they start to see success and they think always more is better. But, at some point, if you again within that relevant range, those assumptions kind of break down once your fixed costs really go up. And some other real estate related problems. So I'll let you all do some work there. It's kind of a fun little project just to look into it. Kind of interesting, but Circuit City, forgot about that business. So Best Buy is still around. I think Best Buy is still having problems though too, and maybe even be interesting to kind of look at Best Buy as a company as well, currently, and see how they're faring against other companies like Amazon still, so pretty interesting. So hopefully this video is helpful for y'all as you're working through these problems. I think some of these, especially like this PR tab problem, that one is pretty tricky. So happy to walk y'all through it, and we'll do some more practice in class. And thanks everybody for following along. Have a great evening. It's evening here, at least when I'm making this video, and I will see you soon. Alrighty, bye everybody.